Eurodollar could potentially make you very, very wealthy in 2026. So as you can see, I'm already positioned in a short with a very, very small size of 0.02. So let's have a look into Eurodollar, and I'm going to explain to you my points and my arguments for why I think we could have some serious downside coming on Eurodollar. Well, the story starts with the US dollar, of course. So we've got this trend line that's been established since 2011. Every time we come down twice. So we can see here, one touch, two touch, one touch, two touch. And now we've just had our second. So we've had one touch and we're currently on our second touch. Now, of course, that doesn't mean a whole lot. We're not doing a Tory trades around here. However, on a weekly and monthly time frame, we should be looking at historical patterns and the way these markets behave over time. And the behavior that we're seeing on the dollar is very reminiscent of how it's moved previously before we've had dollar rallies. But the interesting part comes when we go to our monthly time frame on Eurodollar. But keep in mind, we already have a pretty strong technical setup on the US dollar. But if we draw our fib level from the high here, which was established in 2014 in April, and we draw it to the low from, when was this, September 2022, what do we see? Well, price is currently at the 50% retracement level with the fib. Now, that is absolutely key, because don't forget, the fib isn't just a tool that retail use. 50% levels are used widely across the institutional landscape. It's used widely across the retail landscape also. It's not a level you should just completely ignore and write off because it's on TradingView and it's a tool. It's a very, very key level in a lot of markets. In fact, every market really. It's not just the fib level. We've got a couple of other things going on here. We've got the 200 above our 50 indicating that this is a downtrend. We've got relative sort of downtrend here as well with these lower highs, and this fib level lines up very nicely with these previous lows that we saw in the early, well, not early 2000s, but 2012, 2010, 2008. So from a technical view, this is looking like it could be a beautiful drip to the downside. Now, there is one more factor that I want to point out on this chart, and that level is 1.2. So 1.2 has been verbally spoken about by the ECB. This is when we could start seeing some resistance come into the Eurodollar. Now, I do think we could start layering some positions as I've got here. Of course, again, it's a very, very small size because I'm trading this with some sort of optimism that we could see some trickle to downside over the next couple of months. But 1.2 could be the resistance because, again, we've had the ECB verbally speak about 1.2, and beyond 1.2, so sort of towards 1.25, 1.3, that's when I think we could get some serious problems within Europe due to the value of the euro, such as exports and inflation. So there is that sort of sentiment there of, well, why would we want to buy the euro past 1.2 when the ECB's already spoken about it, and beyond that point, we might actually start seeing the euro be a hindrance to Europe. Now, I don't really have a technical target on Eurodollar. I'm not looking for a specific level. Again, this is more just a placeholder position just to see what happens. If I do manage to build up a position over the next couple of weeks or even months, cool, we'll just let it run, see what happens. Now, the important factor that you should always keep in mind when you're trading like this is this very beautiful tool called the Carry Trade Scanner. This is on the Edge Finder. You can also, there's free ways to get this to see what you get paid or will pay. So on Eurodollar, we can see that we do get paid to hold short positions. So even though I might be in drawdown, although, you know, very, very small drawdown due to a very small position, I am earning some money on the trade as I hold it overnight. So that's quite a nice little factor to have in mind. It does reduce that drawdown. It creates a little bit of a buffer for us as well. However, this isn't the most interesting part. I was on the A1 live stream yesterday talking about this sort of idea, and Nick came on and actually pointed this out because I don't really use seasonality very much. However, this is quite interesting. So we do have our 10-year average performance for Eurodollar and this white line here. And we can see the red line is our year-to-date performance. So this is how Eurodollar has moved this year relative to its 10-year average, and we can see it's followed pretty much perfectly. Obviously, it's not one-to-one. It'll never be one-to-one, but the general idea is completely fine. You know, it's very, very close. We can see as we head into the end of the year, we do see a very bearish sentiment with the dollar, a very bearish historical price movement with the dollar. And we should all know by now that we do generally see the S&P and the dollar, the US in general, do very well towards the end of the year in the run up to Christmas. So there is sort of the historical play there as well. So if we look at the US heat map now, we can see that there are some pretty good factors going on. The dollar has had a very, very rough time over basically the past 12 months. However, now we are seeing a little bit of positive data. Well, actually quite a lot of positive data. We've got GDP growth that came up quite significantly to 3.8. Manufacturing PMIs are doing well. Services PMIs are doing okay. Doing well at 52, showing expansion. Manufacturing PMIs are okay. Definitely not the best, but they're okay. Retail sales are positive. We've got just good data for the dollar at the moment. Now, where I'm getting a little bit attracted is right here with the COT positioning. So we can see that the euro is pretty stretched. When I say pretty stretched, I don't necessarily mean sort of the percentage, although the percentage is quite large to the long side. What I mean by stretched is being significantly more bought than sold for a very long time, or positions have been increasing for a very long time and have stayed elevated for a significant period of time, showing that we might have a little bit of, whether it be profit taking, hedging, diversification, whatever it is, or even just a change in data to remove some of these long positions, start closing those trades, pushing the euro dollar down. And we basically see the opposite thing with the US dollar. We can see again, we had a pretty nice bullish sentiment in the start of the end of 2024, and then basically this year it's just been a drag. It's just been sold and sold and sold. You can see all of these positions getting reduced, and it's got to a point now where the dollar is very, very stretched to the short side. I made a video on this actually earlier in this year, talking about how the dollar it's just basically crowded. It's a very, very crowded short position. Now, there is something else a little bit interesting here, and this is by JP Morgan. This is a relatively recent report. It's not too modern. It came out in basically the end of July this year. However, I would say it's still completely relevant. And what we see right here is the fair value by most estimates is closer to 1.11 to 1.12, but we do not expect this to be a constraint on the euro dollar in the medium term. At worst, we expect a period of consolidation before resumption towards further strength. Now, we can see that JP Morgan do expect euro dollar to climb to 1.22 by March 2026. I am willing to take the opposite side. Now, again, this is a complete foundation. I have not really that much to back up this idea yet. I am sort of pitching it, thinking about it, and exploring the idea. Again, I've got a very, very small position on just to see. And then, if we start seeing developments to favor this idea, I can start building up and adding in and start really taking this a bit more seriously and do a bit of a deeper dive. But at the moment, I think there are a couple of little jigsaw puzzles or jigsaw pieces, a bit of building blocks there to potentially support this trade. Now, I guess the next point of focus should be obviously the central banks. Now, we already know that the Fed is going to cut rates at some point, or continue to cut rates. That's not a huge shock. We already know that's priced into the markets. If anything, we actually saw the opposite type of mood you would expect when the markets were expecting quite a large, aggressive easing cycle, and Powell basically wrote that off and said it's not going to be the case. So we do actually have a relatively hawkish tone by the Fed, whereas the ECB is pretty neutral. So although the ECB is neutral, we do have a report here by ING that came out on the 1st of October, so 2 days ago. And they said the pickup in inflation to 2.2% in September was mainly due to energy effects, which will fade in the months ahead. So what do we expect when inflation is at 2.2%, which is relatively around target, and then inflation drops even further? Well, I'll let you put those pieces together. A small undershooting of the inflation target actually seems realistic around the turn of the year. Expect the ECB to hold rates steady for now. So if we can see a couple of different things start to line up, if we can see the labor market start to stabilize within the US, we can see inflation either stay sticky in the US or even climb higher, that would be a great environment for the Fed to continue holding rates, or at least stop the easing cycle. And on the other hand, if we see the the Eurozone's inflation start to decrease, we see worse data in Europe overall, again, that could be setting the stage for some euro dollar bearishness. So This by no means is this a bearish signal. I'm not telling you to go and sell euro dollar or to start thinking we're going to see a crash. That's not what I'm saying. What I'm saying is I think we do have some reasons to expect it. But just because we have some reasons to expect it doesn't mean it's going to happen. I really need to do some data dependence here, like Pal says. I'm just sitting on my hands a little bit. I know I've got a position on again. As I've reiterated before, it's very small. So it's not a huge problem. If this doesn't work out, I can cut it. It won't bother me in any way. Guys, take care. Again, this isn't signal. Please don't go in full margin euro dollar shorts. That won't work. Have a good one. Stay safe. Don't get margin called. And I will speak to you very soon.